Welcome back to another edition of Sunday School with your boy Buck Bandit P here on the Financial Corner, where we break down investing for average everyday people so we can go out here and get this money. But you already know the motto around here: no shortcuts, no excuses, just progress. We try and build generational wealth, and it ain't as hard as people think. Just take a little strategy and a little discipline. Thank y'all for being here once again, man. Appreciate all the love that I'm receiving and all that. And also, man, if you want to get off the sideline and start printing some money with us, make sure you grab your free stock from Robinhood and all that. And also, man, there's a nice announcement, man. The Buck Tees are in once again. Make sure you hit the link down below, man. Make sure you check out that merch at the Buck Bandit shop in the Financial Corner collection. Make sure y'all check that out and all that if you want to grab some merch. Without further ado, let's get right into the episode. What we talking about this week. Pull up a seat, grab your notepad, and let's get right down to business, man. Y'all know what we here for. Y'all know what we do around here. We trying to see where the money is so we can make some of it. The market has been running. And when I say running, that thing is ripping and running. Is it too high? Is the market too high, and is it too late to get in the game? Let's break it down. Before we break it down, before we get into is it too late, is the market too high, let's go into some history right quick. Can I break down some history for y'all right quick? Because a lot of this stuff is really amazing, and once you know it, it kind of gives you a broader view of the market and it lets you pan out a little better. Market history in the last 50 years. Let's go through it. In the 1970s, what I told y'all about in the other video of stagflation, that's a worry right now. Well, that really happened in the 1970s. Like, the prices was high and the economy was just stagnant. It was a rough time in the 70s. The S&P nearly lost 50% over that 10-year span, okay? Now, let's get into the next time that a crash happened. What I'm going over right now is the crashes that happened in the market over the past 50 years. So that first one was stagflation in the 70s, which was crazy. S&P lost nearly 50%. The next one was the crash of 87. It was the first Black Monday. The Dow dropped 22% in a day. And if you know what the Dow, that's basically industrials. Anytime the industrials drop 22% in a day, it's crazy. Let's get into the dot-com bubble after that. So we got stagflation in the 70s. We got Black Monday in 1987. Then we got the dot-com bubble in 2001. That's when the NASDAQ fell 77% over, like 2 years span. That is crazy work, bro. If you could zoom out and realize, like, hold up, the NASDAQ fell 77% in 2 year span. So it was, at the time, it was 5,000. That was the high of the NASDAQ at the time. And it dropped all the way down to 1,100. That's crazy work. After that dot-com bubble, it took the market 15 years to get back to that 5,000 level. So just keep that in mind. After that, but the reason why the dot-com bubble, the market didn't get to all-time highs after that is because after the dot-com bubble, we had the '08 housing market crash. And the housing market crash, when that happened, the S&P, the Dow, and the NASDAQ fell 50%. That was just crazy. It was already going through the dot-com stuff and all that, and then the housing market came after that. It was so hard for us to get back to all-time highs. It didn't get back to it until, like I said, 15 years later, which is crazy. The next time that the market crashed was, and y'all probably remember this because this is the most recent one, the COVID-19 virus pandemic play. Everybody know the market fell crazy. The S&P fell 34% in a month, which is crazy. But what makes that downturn so crazy is because the market bounced right back up super fast after that. I just wanted to break down the crashes that happened in the last 50 years so we can understand that the market does go through stuff. It'd be a lot of stuff going on. Let's get into that crash in 1987. What I found out is what happened in 1987, the circuit breaker hit. Remember GameStop, when people was trading GameStop and they halted trading on Robinhood, like you couldn't sell, you couldn't buy, do nothing? That comes from the 1987 Black Monday, because that was the first time it happened and they had to prevent that happening because the circuit breaker, what that means is like when one of the major indices like the S&P, the NASDAQ, or the Dow, when that drops, crazy. That's a circuit breaker. That's going to cause everything else to drop. So when that happened in 87, they said we got to prevent that. So now when you trying to trade a company, it's real volatile and they stopping you from buying and selling and all that. That's where that comes from, the 1987 Black Monday crash. I didn't know that. So that's why I said, get your notepad out. This ain't just entertainment. I want to teach y'all some stuff so we can know how to prepare ourselves when we can see similar stuff happen in the future and in the present. And also in the 87, what was new was computer trading. So keep that in mind. The reason why things kept falling because computer trading was actually a thing. And what happened was it triggered the auto trading in the computer system. So it was like auto selling, and it kept selling and kept selling, and it made everybody else sell because the computers were selling. What happened was it created a bubble, just how people say the AI bubble. It creates a bubble, and then when the bubble pops, people are left holding the bag, banks go under because everybody, once you know all this history and you realize, oh, they putting stuff into place because they don't know what the fuck they be doing. This is why I'm trying to teach. Well, not even teach because I ain't no damn teacher, but that's why I'm trying to tell you the stuff as I learn it, because these people don't know what the hell they be doing either. They breaking circuits, they causing inflation, they causing recessions, in war. They don't know what they doing either, bro, but they making a lot of money while they doing it. So we just get some of this money too, because it ain't really rocket science. All you gotta do is really stay invested. In '08, what happened was when the housing market crashed, the reason why the housing market crashed, because they was giving people loans who didn't qualify for them, basically. So they was making up fake loans for these people just so people could get a house. People are left holding the bag, banks go under because everybody calling for them loans. Companies go in debt because they got to take them assets back. Oh yeah, you can't pay your mortgage, give me your damn house. Whoever really owned the loan. That's what happened in '08. And that's why now the requirements got tighter. You get a house now. Like now is more important than ever to get a house because it's not going to get any easier ever since '08. And they was making up them tranches and them triple back mortgages and all that bullshit that really wasn't real. They was just making money out of thin air. They not going to allow that to happen. So now it's going to be even harder to get a house. That's why it's important to know what go on in history, because they changed the rules after shit happened. And in COVID, what happened was why the economy bounced back so high real fast is because what they did was they printed money. They did what we call quantitative easing. And all that was people think they print money, but they don't really print money. What they do is they add debt to their balance sheet, and then they go to the financial institutions, your Goldman Sachs, your JP Morgan Chases, and they issue bonds. And when they buy bonds, when the banks buy bonds, then that's how they can get the cash that they just put on their balance sheet. So it's not really like they print money. They just buy bonds, and then that's how the financial institutions inject that money into the market, because now people gonna buy houses, the mortgages gonna come down and all that. But the thing is, when you add too much debt to your balance sheet, that's why they say it's not a good idea, because we already trillions of dollars in debt. So when you add too much debt to your balance sheet, what it does is it creates an environment where people can't afford to live, like, because people still gonna lose their jobs, the inflation still going up. But if we're gonna create a stagflation scenario like in the 1970s, what everybody was talking about. So it's good to know history, so when you see stuff happening again, you like, oh, this is what they doing. Okay, because in 2020, the reason why everybody was mad, the rich got richer and the poor got poorer, because what they did is they issued all them bonds. All that did was make the financial institutions make the money cheaper for people to buy assets, and the rich people bought more assets and the poor people bought more liabilities, so the wealth gap just widened. But you don't understand that if you don't understand how money moves, you don't understand inflation, you don't understand what the Federal Reserve do, you don't understand the stock market. You just gonna think, oh, well, I'm broke because, I'm working this nut behind job. No, it's because you don't know the information and you don't know how to invest. That's the only difference. That's the only difference. The stock market is the great equalizer. Let's get into part one of, is the market too high? I had to give y'all a little history lesson. So let's get into part one, is the market too high? Goldman Sachs, I just talked about the financial institutions, right? This is funny. Goldman Sachs predicts the market is going to rise 6% from here. They saying it's going to go from 7,100 where it's at right now to 7,600 by the end of the year. To people who are beginners, that's like, all right, 6%, that don't matter, whatever, I'll wait, This is where you're going wrong. 6% don't sound like much until you factor in opportunity costs. Let's say the market go up 6% and you don't invest. If you just stay in flat, you're not just staying flat, you're falling behind. Because what's going to happen is inflation is still going to go up. Inflation still going up, taxes is still here, and you probably ain't going to get a raise at your job as much as the rate of inflation. You shouldn't be asking, is the market too high? That's the wrong question you should be asking yourself. What you should be asking yourself is my cash losing value faster than the market is growing? That's the question you need to ask yourself. Not, is the market too high? Not, is it too expensive to invest? No. Is my cash going to lose value faster than the economy is going to grow? And if the answer is yes, you need to be investing. I don't care if it's $5, $10, figure it out. You need to be investing because you think you saving and stacking and all that. No, you're falling behind. And that's what people get wrong. I dropped a video on my Instagram too. Make sure y'all go check that out. I showed the video of a saver versus an investor over like 20 years. The saver had some bread, but the investor had like 2-3 times more money than you because you're not going to keep up with the pace of inflation if you just saving. Now, part 2 of this, the high price orthodox. Since the 1950s, the market has hit new highs over 1,300 times. I'm going to say that one more time. Since the 1950s, the stock market has reached new all-time highs over 1,300 times. So with all of the crashes I just said, we got the stagflation in the 70s, we got Black Monday 87, we got the dot-com bubble, we got the housing market crash, we got COVID. The market hit all-time highs 1,300 times through all of that. Let that sink in. You can't worry about time in the market. I'ma wait till the market come down to invest. No, time in the market beats timing the market. I don't know who coined that phrase. I don't know who made it up, but it's a dope ass investment phrase and I'm always going to use it because time in the market is always going to be trying to time the market because you're going to miss out on gains. Because even if it pull back, you can just put more money in it and lower your average cost. And now when it go up, you got a better percentage than you just pulling your money out, waiting for it to drop and then put your money back in. You're going to miss out on them gains. Dollar cost average beats waiting for the pullback. All dollar cost averaging is putting the same amount of money in the market every time. Like you get paid every week you putting $25 in the market. I know it don't seem like a lot. Trust me, just do it. $50 every 2 weeks. Do that consistently. That's going to be any bull market, any of that. And this is the superpower, part 3, the Roth 401k. I'm screaming from the top of my lungs, from the top of the mountaintops into the day that I die. I wrote this in my book because I'm coming out with a book too to help y'all out too. It's a real simple, easy read, but it's easy to break down. And I wrote down, it's like the Roth 401k is like your secret money map to financial freedom, bro, because it's tax free. We know in 10 years these taxes are going to be higher. We know in 10 years inflation going to be higher. The reason why the Roth 401k protects you from the bull market, protects you from all of that, because you tax when you put the money in. So when you withdraw that money later, 10, 20 years down the line, you're not going to get taxed on taking all of your 150, 200,000 out. But most likely you're going to be financially literate. You ain't even going to take all of it out. What you're going to do is you're going to live off the game. And that's how the game is played. So you can always keep your assets in place. And you can just borrow against them if it really get that bad. But for real, if you got enough of a nest egg, you can live off your dividends and your profits, bro. And just keep your initial investment in there. You just live off your profits and just keep your initial investment in there. Like, that's how the rich play the game, and just stack up on your assets. That's the power of the Roth 401k. Take advantage, because the bull market don't affect you as much. The bear market don't affect you as much. Inflation don't affect you as much. Trump don't affect you as much. None of that affects you as much when you in a Roth 401k, because you're not focused on this year. You focused on 5, 10 years down the line. And you could borrow against it too. That's the secret. You could borrow against it like penalty free. In part 4, this is that we got to get into this. The psychology of the market. This is so important. I seen a video, the girl was like, y'all think it's the money. It ain't. It's the mindset. So true. The psychology of the market is so important, because you don't want to get emotional with your money. You do not want to be emotional behind something that these people are printing and that they can manipulate, bro. Don't be emotional behind this money. You got to control the psychological effects that the stock market will have on you. Read the headlines, just don't take them to heart. The geopolitics is here. The AI spending, it's a bubble. It's not a bubble. We in a bear market. We in a bull market. Just read them, see where, all right, bet, all right, boom, boom, boom. We not taking it to heart. Trump's still in office. Like, bro, it's a whole lot of stuff. If you gonna get mad, you gonna be mad all day, every day, and it's gonna throw you off course of what the focus is. That's the plan. They want to throw you off course. Don't worry about what Trump doing and all that. That's gonna work itself out. There's still money to be made. I already showed y'all. If y'all don't know, go look at all the old videos, because a lot of them stocks that are in companies I said, they are popping right now. So if you sleeping, that's your fault. Control the psychology, control your mindset, get more in tune with yourself. And also, a last point of this, man, the market is a machine designed to transfer money from the impatient to the patient. I'm gonna say that one more time. The stock market is a machine designed to transfer money from the impatient to the patient. You gotta stay patient. Look long term. So to recap, don't fear the peak. Highs are often leading to more highs. Just seen the market hit an all-time high and people like, oh, is it too high? And then what happened the next day? It hit an all-time high. Get in the game. Don't worry about it, it's too high. Don't worry about that. And focus on the Roth 401k. Most people say it's $7,500 too much. So if you ain't even maxed out your Roth 401k, that should be your main focus. Oh, I need $7,500 to max out this Roth 401k. That should be your main focus. And even if you don't max it out, what's going to happen is over a couple years, you're going to have a nice little nest egg, and then you'll be like, all right, bet. Now I can run some options. Now I can, because you're going to be more comfortable. That's what's going to happen. And also stay calm. Focus on years down the line. Like I said, don't focus on the day. Don't focus on the day. Don't focus on this month. I mean, when you're going to watch it, we focus on years down the line. And like Ian said, if you want generational wealth, it's no magic thing you got to do. All you have to do is hold on to something for a generation. Ta-da! So if this helped you, share it with somebody. If this, gave you some knowledge you ain't know, all I ask is you share it with somebody, and you already know, man. Appreciate y'all, and I'll see y'all here next week. Class dismissed.